Welcome to the Deep Dive. Every day, the financial world generates just this avalanche of news, right? What if you could cut through all that noise and instantly grasp what's truly important? Well, that's our mission here. Today, we're doing a deep dive into the second quarter 2025 earnings of, well, one of the world's financial titans, JPMorgan Chase. We've gone directly to the source of their official earnings report, the full analyst call transcript to pull out the most important insights, surprising facts, and the strategic thinking straight from their leadership. Think of this as your fast track to being genuinely well informed about this financial giant. We'll explore their performance, their outlook, and maybe most importantly, how they're balancing this massive capital strength with an evolving economic and regulatory landscape. Okay, let's start with the big picture then. Those headline numbers for Q2 2025. JPMorgan Chase reported net income of $15.0 billion, or $13.2 billion when you factor out a significant tax benefit. Managed revenue came in at $45.7 billion. Now, Jamie Dimon, the chairman and CEO, he immediately called these another quarter of strong results.
So looking at these big figures, what's the immediate takeaway for you?
What's immediately striking isn't just the sheer scale of it all, but the profitability and efficiency behind those numbers. Even with some top line changes, we're seeing an 18% return on equity ROE and a 21% return on tangible common equity ROTCE. These are they're very strong indicators of how effectively they're using shareholder capital. Yeah. Now, you might notice that overall managed revenue was down 10% year over year, and that sounds like a drop. But it's really crucial to understand that this dip was largely influenced by a one-time gain from Visa shares in the prior year's results. That really skewed the comparison, so it's not really an underlying decline in their core business performance.
Right. That context is key. It certainly sounds like they're sitting on a massive amount of financial strength. Their CET1 ratio, that key measure of a bank's core capital, it stands at a robust 15%. That's far exceeding regulatory requirements. And they're holding an extraordinary $1.5 trillion in cash and marketable securities. Just huge numbers. So the question for many is, what do they do with all that capital? And their answer, well, it might surprise you. They're giving a lot of it back. They announced an intention to increase their common dividend for the second time this year. That leads to a 20% cumulative increase compared to late 2024. Plus, they repurchased $7.1 billion in common stock this quarter, and they've got a new $50 billion repurchase program authorized. So what does this tell us about their approach to value creation and maybe their confidence looking ahead?
Oh, it speaks volumes about their confidence, actually. Their CFO, Jeremy Barnum, he vividly called this excess capital earnings in store. I like that phrase. And JPMC has a very strict hierarchy, sort of a pecking order, for deploying it. Their absolute top priority is organic growth, investing in their existing businesses first. Next comes inorganic growth, so acquisitions. Then maintaining a sustainable dividend, and only then share buybacks are last on the list. They're very clear they have a, quote, high bar for any acquisitions. They evaluate them financially, strategically, and culturally. That last one's interesting, too. This whole strategy, it suggests they truly believe their best returns come from investing in themselves. It signals a strong conviction in their internal growth opportunities.
Okay, so with that impressive capital position, let's zoom in a bit on where JPMC is putting it to work. We can start with the Consumer and Community Banking segment, CCB. It's often a kind of bellwether for the broader economy, right? This division reported a strong net income of $5.2 billion, up 23% year over year, with an impressive 36% ROE. So what drove that strong performance on the consumer side?
Well, we saw several powerful drivers for CCB this quarter. There were higher asset management fees, particularly from JPMorgan Wealth Management, and increased card income, which they said was largely fueled by higher revolving balances, people carrying more debt on their cards, essentially. Auto operating lease income also contributed significantly. But what really stands out, I think, is Jamie Dimon specifically mentioning the addition of approximately 500,000 net new checking accounts this quarter.
Wow, 500,000.
Yeah, it's a huge number. And that directly drove sequential growth in their checking account balances. Oh, and for those of you maybe with their credit cards, they also launched a refreshed Sapphire Reserve and a new Sapphire Reserve for Business. They noted positive early reactions and strong new card acquisitions from those. So it shows a clear focus on both attracting new clients and enhancing the value of their existing products, keeping current customers happy too.
Right. Okay, moving to the institutional side then, the Commercial Investment Bank, or CIB. They had a net income of $6.7 billion, up 13% year over year. Investment banking fees were up 7%, and they maintained their #1 global ranking with an 8.9% wallet share. Plus, markets revenue jumped an impressive 15%. Jamie Dimon noted that investment banking activity, quote, started slow but gained momentum as market sentiment improved, and the outlook is now notably more upbeat. So things looking up there.
Yeah, this really suggests a significant rebound in deal-making and trading activity as the quarter actually progressed, even with some early volatility. And their ability to deliver such strong results across both fixed income and equity markets, I mean, both were up strongly, 14% and 15% respectively. That really highlights their broad capabilities.
The diversified strength.
Exactly. Diverse revenue streams in capital markets. It shows they can perform well in different market conditions, not just when everything's going perfectly. Plus, another interesting point, average client deposits in CIB were up significantly too, 16% year over year. That's another good indicator of increased client activity in those institutional segments.
Got it. And finally, let's look at their asset and wealth management segment, AWM, that also delivered strong results. Net income up 17%, another really high ROE of 36%. Assets under management, AUM, reached $4.3 trillion, up 18% year over year, and client assets crossed a massive $6.4 trillion. So what's the core story behind this impressive growth here?
Well, this robust growth in AWM was fueled primarily by strong net inflows. They brought in $80 billion of new client money for the quarter. That, combined with higher average market levels, obviously helps boost the total value. But those inflows, they powerfully demonstrate their continued success in attracting and retaining client assets. And that's, a key indicator of long-term stability and growth for any wealth management business. It really speaks to sustained client confidence in their offerings, especially in what's still a very competitive market out there.
Okay, so solid performance across the board, it seems. Now, Jamie Dimon's comments on the U.S. economy are always, closely watched. This quarter, he called it resilient. But at the same time, he flagged this whole list of significant risks: tariffs, trade uncertainty, worsening geopolitical conditions, high fiscal deficits, elevated asset prices. Quite a list. He emphasized the importance of preparing the firm for a, quote, wide range of scenarios. So what is this striking balance, this sort of resilience versus pervasive risk? What does that mean for their overall strategy going forward?
It truly reflects a cautious but deeply prepared stance. That's how I read it. While the underlying U.S. economic fundamentals appear solid, the job market's still strong. But global uncertainties clearly remain top of mind for their leadership. You can hear it in his tone. Their emphasis on preparing for a wide range of scenarios isn't just like a talking point. It suggests a strategy focused on building a really robust financial foundation, one that can weather potential shocks rather than just optimizing for perpetually favorable conditions. It's about building resilience into the bank itself.
Yeah, that makes sense. And this deep dive into the earnings call, it also revealed some pretty fascinating dialogue around how JPMorgan thinks about capital, especially with new regulations maybe on the horizon. Their CFO mentioned an increase in risk-weighted assets, RWA, those assets needing more capital held against them. This was driven by, quote, wholesale lending across both CIB markets and banking, and an increase in other markets activity, as well as an increase in card loans. He then called JPMorgan the Switzerland of financing, doing, quote, everything, and lending private credit, M&A financing, inventory, you name it.
Yeah.
But it was Jamie Dimon's really passionate take on the regulatory environment that really drew my attention.
Indeed, yeah. He was quite vocal. Dimon strongly argued that regulators need to, quote, step back and kind of look at the big picture. That was his phrase. He pointed to what he sees as significant overlap and, frankly, duplication in crucial rules. Things like the supplementary leverage ratio, SLR, the GSIB surcharge for the biggest banks, CCRR, the stress tests, and Basel III, those international banking regulations. He basically believes the entire system could be made simpler, cheaper, more effective, more transparent, and safer, all at the same time without actually compromising stability. In fact, he went further. He asserted that recent events like the failures of Silicon Valley Bank and First Republic, well, they didn't need to happen if certain things were modified to create, quote, more liquidity, more loans, and a safer system. Pretty bold statement.
Wow. And he didn't just critique, he actually came with some proposed solutions, right? He suggested that reducing constraints from GSIB, LCR, the liquidity coverage ratio, and CCRR could directly lead to more lending throughout the economy, make it easier for banks to lend. He even brought up the securitization market, where mortgages get bundled and sold. He argued that these processes now involve excessive origination and servicing requirements. Basically, tires red tape involved in creating and managing these mortgage-backed assets, adding significant, maybe unnecessary cost. He claimed it could be making mortgages 30 or 40 or 50 basis points more expensive for you, the borrower. So what's the real impact here? What are the stakes in these regulatory discussions for JPMC and, the wider financial system?
Yeah, this really gets to the core trade-off, doesn't it, between safety and efficiency in the financial system? JPMorgan's argument, essentially, is that current regulations might inadvertently be hindering beneficial lending and market-making activities without a proportional reduction in the overall risk. They're basically saying some rules are making the system less efficient, more costly for consumers and businesses, without actually making it meaningfully safer. It's a compelling argument because it directly connects to your ability, the listener's ability, to access credit mortgages, car loans, business loans, and the overall health of the economy. It's not just a bank problem.
Oh, and on a related note, Dimon's comment about possibly seeing peak private credit due to low spreads and high valuations, that was also quite provocative.
Yeah, I caught that too.
Especially since he then noted JPM can handle those private credit opportunities themselves. It sort of suggests they see opportunities in areas where maybe others are getting a bit overextended. A bit of a warning shot, perhaps. Interesting. Okay, beyond the core numbers and regulation, the call also touched on some cutting-edge topics. How is JPMorgan navigating this evolving world of stablecoins and deposit tokens?
Well, they're clearly committed to being, quote, involved in both JPM deposit coin and stablecoins to understand it, to be good at it. They want to be players. But while they don't yet see a clear reason to prefer stablecoins over, say, traditional payment methods, they definitely acknowledge that fintech companies are actively trying to, quote, create bank accounts and get into payment systems and rewards programs. So they need to be cognizant and involved in that space. They can't ignore it. On the topic of AI, Jamie Dimon was pretty direct. There's no reason for us to own a large language model like ChatGPT.
Okay.
Instead, their focus is on using LLMs and leveraging their own vast data to directly help their customers. Applying AI, not necessarily building the foundational models themselves.
Got it. And what about open banking, this movement where customers share their financial data with third parties? What's JPMorgan's stance there?
So JPMorgan does support the customer's right to share their information. They're clear on that. But, and it's a big but, they do so with significant caveats. They want clear agreements on what exactly is being shared, for how long it's being shared, and critically, they want to prevent remarketing or reselling of that data to other third parties, protecting customer data, essentially.
Right, privacy concerns.
Exactly. And maybe most importantly, they advocate strongly for a liability shift. This means JPMorgan shouldn't be held responsible if you, the customer, give your bank passcodes to some third-party app and then fraud occurs through that third party.
Okay.
So it really raises an important question about personal data responsibility and accountability in this digital financial world. Like, who's ultimately on the hook if something goes wrong when data is shared?
Yeah, that's a huge question. Okay, one last area. Despite all those economic uncertainties Jamie Dimon flagged, what's the latest on actual credit quality, particularly for consumers and businesses? Are they seeing any cracks appearing in their loan books yet?
It's interesting. They continue to, quote, struggle to see signs of weakness in consumer credit specifically. And they attribute this primarily to the strong labor market, with the unemployment rate still low at 4.1%. People have jobs. They can mostly pay their bills. Their net charge-off guidance for card services, for instance, remains unchanged at 3.6%. No red flags there yet. Oh, and interestingly, they clarified a recent jump that some analysts noticed in consumer non-accrual loans. They said it was mostly a technicality.
A technicality?
Yeah, related to home lending customers in the LA area using forbearance options because of wildfires. They said the actual loss expectation was, quote, de minimis. So basically noise, not a real credit issue.
Okay.
And for commercial credit, they largely feel the same. Pretty stable. Though they did note that some specific sectors, maybe those heavily involved in international trade, might feel the impacts of tariffs more directly than others. But overall, still looking pretty healthy.
Right. So this deep dive, it's really shown you, I think, a picture of JPMorgan Chase is far more nuanced than just looking at the headline numbers. We've seen this incredibly powerful institution navigating a complex world, yes, with an undeniable capital position, but also making strategic investments in growth areas like payments and wealth management. And, maybe surprisingly, using a very direct voice to try and shape the future of financial regulation. They're not just, reacting to the world, they're actively trying to influence it. So, as we've heard, JPMorgan Chase is making these significant investments in their existing businesses, and they're pushing hard for regulatory changes they believe will strengthen the entire financial system, not just them, but the whole system. But this raises, I think, a compelling question for you, the listener, to think about. If regulations were indeed simplified, cheaper, more effective, more transparent, and safer, as Jamie Dimon suggests they could be, how might that fundamentally reshape not just the profitability of large banks like JPMC, but also the whole competitive landscape?
Think about traditional banks versus private credit firms versus the fintech disruptors. And ultimately, what shifts might you see in the cost and availability of the financial products and services you use every day in the years to come? Something to mull over.